The second half of 2020 began with solid gains in all 5 major markets. The returns were largely driven by optimism around the global economy's continued recovery post-lockdown. The greatest gains were seen in the emerging markets, as the international indices continued to recoup the losses from first quarter. But what has become truly astounding is the difference in returns between the tech-centric Nasdaq and the Dow Jones Industrial average year-to-date. Likewise, while the S&P 500 has traded back up to nearly flat on the year, the span of returns in the underlying sectors has become significant. With just over half the year completed, energy remains the worst performer with a loss of 40.78%, followed by financials with a loss of 23.74%. As seen already in the Nasdaq performance, the S&P 500 information technology sector sits with a gain of 18%. This span of 58.79% between the best and worst sectors year-to-date demonstrates the stark difference in performance seen in the segments of the greater economy. In fact, only IT, consumer discretionary, and communication services are presently positive for the year. The remaining 8 sectors still sit with losses, with some segments deeply in the red. As we go into the remainder of the year, investors will continue to watch headlines about governors' mandates regarding COVID-19 and the economic impact that will arise from them. Meanwhile, the bond market continued to make steady advances. The Bloomberg Barclays U.S. Aggregate Bond Index added another 42 basis points last week. This rose the year-to-date performance to 6.71%. The 10-year Treasury has remained fairly stable, floating around the 70 basis point level since the early drop-off in March. Friday it closed at 65 basis points. Earnings season begins to build up over the coming weeks. This will give investors an updated picture of the overall fundamentals of the markets, as well as guidance on companies' plans for the second half of the year most are ready to be done with.